Good morning, everyone. Thank you for taking time out for the conference call of PPAP Automotive Limited to discuss the financial results of the quarter and 9 months ended December 31st, 2018. We have with us Mr. Abhishek Jain, Chief Executive Officer and Managing Director, and Mr. Manish Dhariwal, Chief Financial Officer. We will begin the call by opening remarks by Mr. Jain, and then we will have a question and answer session. I would just like to point out that certain statements in today's call may be forward-looking, and we have already put out a disclaimer to that effect at the end of the presentation. So I will hand over the floor to Abhishek, sir. Over to you, sir.
Thank you, Gaurav. Thank you, Janice. Ladies and gentlemen, a very good morning to all of you, and thank you for joining us to discuss the operating and financial results for the quarter 3 and 9 months of the current financial year. To start with today's conference call, I will give you a brief overview of the automotive industry during the quarter under review. During the quarter, the industry witnessed an unprecedented drop of sales during the festive season. The passenger vehicle segment, as per the official estimates, has seen a production degrowth of 9% year-on-year in the quarter under review. A total of 0.89 million passenger vehicles were produced against 0.98 million in the same period last year. The commercial vehicle production saw a growth of 12.6%, whereas the two-wheeler production was at 5.76 million, which is an increase of 9.7% compared to the same quarter of previous year. In the short term, the growth was impacted largely due to poor market sentiments, due to natural calamities, vehicle financing issues, and high oil prices. In spite of the degrowth of the industry, our company was able to sustain growth in sales. While the vehicle production degrew by 9%, our total income from operations grew by 3.7% compared to the same quarter last year. The company derived 98% of sales from the passenger vehicle segment of the Indian automotive industry. Just a small recap of what PPAP is about. So PPAP manufactures polymer extrusion-based automotive sealing systems, interior and exterior automotive injection molded products in India. With its 7 facilities spread across the key automotive hubs in India, the company manufactures over 1,000 different SKUs and ships over 150,000 parts every day to its customer, which include the Japanese OEMs, the local OEMs, as well as other major OEMs in the passenger vehicle segment, as well as the commercial and the two-wheeler segment. The company continues to focus on enhancing its per-car contribution. In 2014, we established an equal equity joint venture to increase our per-car contribution in the rubber parts space. The company is able to attract new opportunities in both sealing system as well as injection products post the establishment of its facilities, which are much closer to the customer now. We continue our focus to build on our core competency and on achieving excellence throughout the gamut of our organization. Now let's take a look at our financial performance. For the quarter 3, our company recorded a revenue from operations of 93.52 crores as compared to 90.22 crores in the corresponding quarter last year. Out of this revenue, part sales amounted to 90.69 crores, registering a growth of 2.8%. Tool sales contributed 2.17 crores and 66 lakhs was the other operating income, which is the subsidy received from the Rajasthan government every quarter. The revenue from operations for the current year till date for the 9 months stood at 311.85 crores compared to 270 crores during the same period last year, registering an increase of 15.5%. Out of this 311.85 crores revenue, part sales amounted to 294.88 crores, registering a growth of 13.2%. Tool sales contributed 11 crores and 5.98 crores was the other operating income. In the midterm, the company continues to exhibit strong sales performance and continues to grow at a higher rate than that of the industry. The company's automotive sealing products were used in 72% of the total passenger vehicles produced in India. Maruti Suzuki, including Suzuki Motors Gujarat, continue to remain PPAP's top customer, accounting for 49% of part sales. The company's second biggest customer, Honda, has contributed 28% to the company's top line for this quarter. During the quarter, 25% of the part sales were derived from new vehicle launches. The company has its presence in the recently launched new models like Maruti, Wagoner, Ertiga, as well as the newly launched Tata Harrier. The company continues to focus on developing strong relationships with its customers in the Indian industry. The company is currently developing parts for 24 new models that are expected to start production within the next 2 years. We continue to scout for value-added opportunities across the various segments. The company reported an EBITDA of 15.96 crores in the quarter as against 19.26 crores in the corresponding quarter last year, and a PAT of 5.94 crores in the current quarter compared to 8.18 crores in the same quarter last year. The quarter under review saw an unprecedented drop of sales of passenger vehicles, which impacted the profitability of the company in the short term. The adverse trend in the commodity prices and delay in foreign exchange compensations from the customer also impacted the bottom line. The company has foreign exchange compensation contracts with its key customers. This compensation has a lag of a quarter. Due to the sudden and rapid disruption of foreign exchange, the company's profitability was impacted in the short term. We are learning and changing the ways we do our business and are focusing on becoming more agile to these changing environments. We are also focusing on finding avenues which are wasteful to further enhance our competitiveness. For the 9 months, the EBITDA stood at 59.99 crores against 56.2 crores in the last year, registering an increase of 6.7%. In spite of the adverse trends, the company continues to exhibit a robust EBITDA margin of 19.2%. The company's PAT for the first 9 months increased by 13% to 26.36 crore compared with 23.32 crores in the previous year 9 months. The company sustained the PAT margin at 8.5%. Earnings per share for the quarter stood at 4.24 rupees, and for the 9 months, the EPS is at 18.83 rupees. Our dependence on interest-bearing debt continued to fall, resulting in reduction of interest cost. The debt-equity ratio of the company as on 31st December stands at 0.14. In the 9 months, we have invested a total of 39.7 crore rupees towards capital expenditure. We have spent 22.3 crores towards new facilities and 17.5 crores on the existing facilities. The capacity utilization for the 9 months stands roughly between 75 to 80% on our company level. Due to the reduced sales, this utilization saw a dip of about 10% during the last quarter. As committed earlier, all our capex requirements are being met by internal accruals. I am happy to report to you that our superior performance has yet again been recognized by another customer, which is Asahi India. We have also won the prestigious Economic Times Polymer Award for the 3rd time in a row. This year, we have won a total of 11 awards from our prestigious customers. This brings me to the end of my opening commentary. Now I would like to leave the floor open for questions and suggestions that you may have. Mr. Manish Dhariwal and I will try our best to answer all of them. Over to you, Janice.
Thank you very much. Ladies and gentlemen, we will now begin the question-answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We take the first question from the line of Vaibhav Bajatia from HNI Investment. Please go ahead.
Yeah, hi sir. Thanks for providing me this opportunity. You earlier in your introductory remarks, you have indicated that there is a decline in profitability, partly due to the delay in foreign exchange component, for foreign exchange compensation that we get from customers. Just wanted to understand this point better. I mean, because of accrual accounting, if we have the contract anyway in place for these compensation, it should have already been accounted for in the book. So how it can then impact our margins? I just wanted to understand that part of your comment.
Yeah, thank you, Vaibhav. Vaibhav, there are two aspects to the foreign exchange issue. One is the receipt of the compensation from the customer, and the second is the continuing increase in the forex rates. So to give you an example, the Q2 was the average rate of dollar was in the region of about 69 rupees, whereas it was 73 rupees in Q3. Now, the money that we receive from the customer is on a lag basis. So for this quarter also, while the third quarter accrual of expenses or the raw material purchase has happened at 73, whereas the compensation even on accrual basis happens till the previous quarter.
Okay.
So that will reflect in a rising FX scenario and increased cost on a quarterly basis. I hope that explains the situation.
Actually, I got your point. So in the fourth quarter, because exchange rupee has appreciated slightly, we should see the good benefit on margin on this front.
That should happen. That should happen.
Okay, I think that's it from my side. Thank you.
Thank you. Before we take the next question, I would like to remind participants, if you wish to ask a question, please press star then 1 on your touchtone telephone. Next question is from the line of Viraj Kacharia from Securities Investment Management. Please go ahead.
Yeah, hi. Thanks for the opportunity and congratulations, for good numbers in such a challenging environment. Hello.
Yeah. Hi, Viraj.
Hi. I just had a couple of questions. First is, if we look at our current, as you said in the opening remarks, kind of volume sales we have reported vis-a-vis the industry numbers, especially the passenger numbers. So just want to understand, if you look at the demand going forward, what kind of indications we're getting, say, from passenger vehicle and other customers, are there further changes in the production schedules, or we have kind of hit the, base minimum in terms of the absolute level of wholesales which they expect?
Viraj, as far as the industry numbers are concerned, so after this, so what happened was till December, a lot of inventories have been cleared by the customers. So that is why if you see the sales numbers, they are not as bad as the production numbers. So all the dealer inventories which had gotten piled up to about 45 to 60 days. So those were basically cleared off by the OEMs by giving all these heavy discounts and all that. So for this particular quarter, we've not yet received any official information from any customer that there is a production cut, especially because there's a dip in the market or something. Everybody is still continuing on their original plans, and we're just hoping that things should be much better in this quarter, compared to the previous quarter.
And just to understand our sales performance a bit better, we said that 25% of sales is now from new products. So if I look at 9 months basis, what kind of incremental growth would have come from new products? And how would have the scale-up of Hyundai been so far?
Sorry, I did not understand your question. Could you repeat it, please?
We said in the presentation that around 25% of sales is from new parts.
Yes.
So I understand in terms of incremental growth, so if I look at 9 months basis or even for Q3, what kind of incremental growth would have come from new products? And, when we say, we were expecting scale-up from Hyundai, for sealing products, so if you can just, touch something upon that, how's the scale-up been so far? How we see that going forward?
Okay. Now, in terms of the scale-up from the new products, this particular quarter, we continue to, reflect the sales of the Maruti new models and the Yaris is below, then Honda Amaze, the new model, in the new models, which is the models that have been released in the last 1 year. So that is continuing to show the trend that the total sales is largely getting reflected by the newer models that have been launched. So that trend is continuing.
Okay, and on Hyundai, how's the scale-up been and what do we expect in terms of... Because we started with one model and then there was some...
Yeah, so Hyundai, basically Eon, we had started our relationship with Hyundai. And now we are on the final approval stage for the Creta production.
So in each of these two models, would we be the 100% supplier or how's our wallet share would be like?
For Hyundai?
Oh, yeah.
So once we have the final approvals in place for Creta, then we will be the 100% suppliers for these particular products.
Got it.
So they are currently importing these products from Korea. And as soon as the final approval is in place, so they have a plan to phase out these imported products and start using our PPAP made products.
Got it. Second question was, you alluded that, typically it takes a quarter or a little bit more than that in terms of for us to get the cost pass-through from the OEs. Now, just to understand, the kind of impact from FX or RM we would have had in Q3. So if we were to see it on a normalized level, what kind of impact are we talking about, which will get compensated in coming quarters?
Sorry, Virat, can you explain that once again?
So basically my question was, if we look in a normal cycle, we would have, there's a normal cost pass-through which happens from FX or RM, which you alluded to, which we'll get in quarter 4 or quarter 1 of FY20.
Mm-hmm.
I just want to understand, what kind of impact, we had because of FX or RM in Q3, which will eventually get reversed in coming quarters.
Yes. Yeah, so see, basically, now if I look at my raw material cost, it has two components. One is the price increase and second is the foreign exchange increase. Okay? Now, that is on the raw material side. Then there is the other expenses also, like freight cost, like power cost, and so other things. So, restricting just to the raw material side of it, the prices have increased and also the FX has increased. Now, partly the raw material cost as well as the FX comes to us. Partly it is something that we have to bear. So, to that extent, the costs have increased.
No, so what I was trying to understand, sir, how much of if I look at an overall normalized basis, how much impact we would have in this particular quarter, which will eventually we'll get it from customers. So, just trying to understand the impact on margins because of, partly FX and RM, which we think we'll get it back in coming quarters.
Very difficult to give you a very, crisp kind of this thing. Yeah, but if you look at our raw material cost, even in the presentation, we have given the movement of our raw material cost on a, 6 quarterly basis.
Right.
So if you observe that the Q3 cost has come down a little at 51.3% as compared to 51.9%, which was in the second quarter. So that because of the receipt of some of the compensation. So it is expected to further normalize as we get the Q4 compensation, and the forex rates do not increase further.
Right.
So as I had explained in the previous question, in a rising cost scenario, the cost will continue to increase, and because the money comes with a lag. Now, if you look at the raw material cost on a normalized scenario, I think 50% is something that we can go by.
Got it. Just one more question was on the capex and the utilization level. So, the kind of demand environment which we are going into, and if you look at the commentary of key OEs across segments, they don't expect any significant improvement in demand, at least for next couple of quarters in the very near term. So is there a change in our order capex spend which we are expecting, say, for FY20? So if you can just touch upon that.
As far as PPAP is concerned, we have a very sensitive in spending our money on capital expenditure. So any amount of money which is spent on capex is being reviewed at a lot of levels differently, and so we are making sure that every money which we spend adds value to the organization. As far as the capex plans for the next year go, so we are not we're not going to change any plan just because the market has gone down on a short-term basis, because all these capital expenditures, everything, these are basically you have to have a long-term strategy for it. And unless and until we show our readiness to the customer, none of the customers are going to give us orders, and they're not going to trust us with new business. So next year, like SMG is going to expand its volume from 500,000 to 750,000 in the next 2 years. So our capital expenditure will be along on those lines. Whatever business we get for the new models from SMG and for these the volume increase.
Okay. What is
so we are valuing every money which we spent in the company, but we're not going to stop our capital expenditure just because of the short-term dip in the market.
Okay. Well, how much were you looking to spend in 20? And how much?
So we're just calculating on those numbers, and we will be declaring them probably in the next conference call or something.
Okay. Just one more question was on the JV. If you can just share how has the performance been for the 9 months, and on the balance sheet side, is that how much net cash or net debt would be on the JV?
JV, again, the overall impact of the reduced sales has been there, but the JV is continuing to grow at a good clip. There has been no further equity infusion from any of the partners. In fact, the cash balance continues to remain fairly robust. So no change in that as well.
Thank you. Mr. Kachari, I would request you to please rejoin the queue for your follow-up, as we have people waiting for the turn. Thank you very much. Next question is from Mitul Shah from Reliance Securities. Please go ahead.
Yeah, good morning, sir. Thank you for taking my question. Sir, I have a question on your production schedule from the OEMs. How indication comes in terms of whether quarterly or yearly basis, what kind of indication they give for the next production schedules?
So our sales are primarily to the OEM customers, and all the Japanese OEMs and everyone are our customer in India. So they basically work on a just-in-time basis, and we get daily production order from them of what has to be supplied to them. Apart from this, they give us some sort of a confirmed schedule which is valid for 15 days. A few customers do that, not all the customers. And generally they give us a ballpark figure for the 3 months and for the complete year. So that 1 year and 3 months number is just basically for planning purpose, but the confirmed schedules are basically 15 days and everyday basis.
So in case of 15-day schedule or anything, if they reduce the production, so is there any clause of compensation or anything in the situation, like current situation where the inventory of the OEMs are much higher, so they would be cutting the production? So any compensation do you get for schedules given to you?
No, we do not get any compensation for any schedule cut, but the contracts which we have with the customer, like foreign exchange compensation, and in case there is any amortization and the volumes are not being met by the customer, in that case we get compensated. But we do not get any price of our products. They do not change just because the customer has cut down the volume by 5,000 or 2,000 or something.
And in terms of molds and toolings, who pays for that? You have to take the entire burden, or they pay as a development charges to you?
It works both ways, but largely now the molds and toolings are owned by the customer, and then there is a element of sale of the tools that are getting developed by the vendor at the time of the start of production.
So next question is on the BS6 related. In case of BS6 coming in, and most of the vehicles are in a race to reduce the weight, so lightweighting. So in that situation, do you have indication for how the increase in content per vehicle for your products, or are you going to get production for any new components which will be totally different than the existing product line for BS6 PVs particularly?
First of all, the product range that PPAP caters to is neutral to the engine technology. So we are insulated from any changes which happen on the technology side, from movement from BS4 to BS6 or from the IC engine to the electric engine. Apart from the changes that will happen on the demand side, so our company's products are basically insulated from these regulatory changes and the engine changes which are...
No, sir, my question is not related to technology. I mean, because of the BS6, people are in a race to reduce the weight of the vehicle, so there is a possibility of further few of the metal parts getting converted to the plastics. So do you have witnessed any such changes, or any of the new products are you targeting which can be again made from the plastics or polymer rather than metal?
We are not replacing any metal product. We don't have any project for replacement of metal product with the customers. But whatever products are being made by us, we are focusing on reducing the wall thickness of those products, so that, and of course eliminating the waste from those products. We call it VAVE exercises. So those exercises are continuously done with the customer at the design stage also, and at the in the mass production stage also. So lightweighting, our products, when we start the designing of these products, lightweighting is a very important aspect which we have to look at, which not only affects the weight of the car, but also the cost of the product.
Right. So last question is on the mix in terms of the extrusion versus injection molding. If you can share approximate number.
Yeah. See, Mitul, the mix obviously on a quarter-on-quarter basis has some plus minus happening, but broadly it is in the region of 50%. Both the injection molding contributes 50% and the extrusion contributes 50%.
So how is this going to pan out in future, maybe in 2-3 years down the line, as extrusion would be having roughly lower margin compared to injection?
the mix of extrusion and injection, it might change. It might change in the future, but not at a very significant level. There might be a plus minus of 5% in both, because we're getting more opportunities in the injection space. But at the same time, we are looking for opportunities in the extrusion space also. So there might be a plus minus 5% change in the contribution that these two product segments do in the company.
So can you share roughly difference between the margins between these two, approximately?
So margins are pretty much similar, apart from the dynamics of each of the business. So somewhere the raw material cost is lower, but the lot of manual processes, so the manpower cost goes high. Somewhere, the raw material cost is high, but the manpower cost is low. But on a company level, they are pretty much similarly contributing to the bottom line.
So both as well as injection has similar margins for you?
Yeah, basically we look at the margins at a consolidated basis.
Okay, thank you, sir.
Thank you very much. Before we take the next question, I would like to remind participants, please limit your question to 2 per participant. You may come back in the question queue if you have a follow-up. We will take the next question from the line of Ankit Merchant from SMC Global. Please go ahead.
Yeah, hi. Sorry, I joined the call a little late. Can you just brief me on the material cost? I believe that has been rising since last couple of quarters now. And going forward, what do you see the trend line?
Yes, the material cost has been rising on account of one, the basic cost of the material increasing, and two, on the foreign exchange part of it.
Sure.
Now, the trend is rising. The foreign exchange part of it is compensated by the customer with a lag. So once that normalizes, then there will just be the element of the raw material cost increase. So going forward, at a normalized scenario, we think it will be in the region of about 50%.
Sure. So 1.3% is safe to assume could be the foreign exchange part? Or could be less?
Broadly, yes.
Okay. And what happened to the employee cost? I believe it has gone up by 18.5% in this particular quarter.
So see, the employee cost, if you look at it on a YOY basis, if you look at it on the total cost basis, because a significant component of that is fixed. So then there is no significant trend emerging. You have this base cost, there is cost of increment, there is some attrition, there is some addition of new manpower. So new plants coming in, there is some for some time there is an incremental on a percentage basis because of the employee cost not getting fully apportioned or recovered from the increased production. So I think if you look at it on a quarter-on-quarter basis, it is on a similar trend.
Sure. Also, I just wanted to understand related to your, the new product or the product pipeline going ahead. So for Maruti, we could be doing the new WagonR. We are also doing the new Ertiga, and we are doing Tata. For Tata, we are doing the Harrier. But what could be our, share of business, one, and what is the contribution, or should I say, what would be the total, components from our company which could be going to this particular models, the total in the value terms?
Yeah, see, specific figures will be difficult to give right now, but for the Harrier, which is Tata's, we are mainly giving the automotive sealing parts. Okay, and for the Ertiga and the WagonR, sealing parts obviously are there, but then we are continually also building our portfolio of injection products there. So because both these models are coming at Manesar, so the injection component would not be very significant as it is for the models that are being made in Gujarat.
Sure. So, but can you just define it? What would be in value terms, like for a WagonR, we could be doing a value of like 3,000 or 5,000 or something, if it's possible for you?
Yeah, offhand, I don't have the figures right now. I can give them to you separately.
Sure. And can I also get the details related to your production for this particular quarter, and what has been the utilization rate for both injection molding as well as the extrusion?
Yeah, the production obviously was as per the customer demand, so it was on the lower levels, and accordingly the capacity utilizations have come down by close to 10%.
Working capital, are you been facing any issues related to payment not coming from your customers on time or so? Is this thing happening?
No, there's
nothing like that. However, obviously, when such things happen, then obviously you have like this quarter lag. That basically gets delayed at times. See, one is the price of the part that you have to get on the normal scenario. That will you continue to get. But then this compensation, there is a separate calculation, there is a separate working that happens for that. So there have been delays in that.
Mr. Mochi,
that's it from my side.
Thank you very much. I would like to remind participants again, please limit your question to 2 per participant. You may come back for a follow-up. Next question is from the line of Dhiral Shah from ACM Investment. Please go ahead.
Yeah, good morning, sir, and thanks for the opportunity. So my question is again regarding to the EBITDA margin. So you just said that 1.3% impact is because of the foreign exchange, right?
Yeah, broadly, it is like not very drilled down, but yes, because we think that on a normalized scenario, the material cost will be in the range of about 50%.
Okay. So what could be the EBITDA guidance, because we have been in the range of, let's say, 20% plus or minus 1% here or there. So do you expect again the EBITDA margin to again bounce back to 20% level in coming quarters?
See, we have always been mentioning that between the region of about 18 to 20% is something that we have been saying, and given the fact that a lot of new plants have come up and all these factors, I think 18% still should be manageable.
18%, right?
Yeah. So the band should be managed.
Okay. And so secondly, sir, what is your growth expectation for passenger vehicle, let's say, for FY20?
See, there are so many uncertainties at this point of time. In the Q1, in the first half you have the elections. In the second half you have the BS6. So there is a fair amount of uncertainty that exists at this moment.
But sir, do you expect, let's say not double digit but high single digit kind of a growth?
I think it's too early to say that, but what we can confirm to you is we will be growing at a rate higher than the industry.
Okay, thank you, sir. That's it from my side.
Thank you. Next question is from the line of Sunil Shah from Turtle Star Portfolio. Please go ahead.
Yeah. Hello, sir. I joined a call bit late, so not too sure if you have shared this information, but my question is on the new model launches. So historically, we have always seen that Maruti has done well. Maruti, I believe, is about 50% of our customers, and maybe Honda is about 30%. So amongst these two companies, whenever new models have been launched, there have been great sales numbers from those companies, like Ciaz and Brezza and all of those. Now they are just relaunching the existing models, whether it's a new variant of Ertiga or new variant of WagonR. But is there any work which we are doing in terms of new model launches, which could be at work in progress kind of, and by the later half of the year they would be launching? So is there any work happening on completely new models coming from Maruti or Honda stable?
Well, Mr. Shah, first of all, I'd like to correct you. The WagonR which is launched now, that is a completely full model change. That is not a cosmetic change.
Okay.
So there are two concepts in the industry. One is called MMC, which is a minor model change, and one is called an FMC, full model change.
Okay.
The minor model change generally happens in 2 years after a vehicle is introduced in the market.
Okay.
And a full model change earlier used to be 8 to 9 years, but now it has come down to about 4 to 5 years.
Right.
So what you see on the road today, the new WagonR, this is a completely new design by the customer, and they spent a lot of money in redesigning the whole WagonR.
Okay.
Same thing for Ertiga also. Ertiga, the new Ertiga which is launched, it is not a minor modification. It is a completely full model change.
Okay. So for Maruti, these two are the ones which are the ones they are working for calendar 2019?
So they've already done these two launches, and there are a couple of other products which are scheduled to be launched, but we are not at liberty to disclose those models for confidentiality purpose. But like we mentioned in the opening script, that we are working for almost 24 new models that are expected to start production within the next 2 years. And these 24 new models are spread across various customers like Maruti, Toyota, Honda, Nissan, Volkswagen, everyone included.
Fine, sir. That's the number I want to get. I'm sorry I missed the opening remarks, but thank you so much for clearing it for me. Thanks, sir. Thanks, both of you. Thank you, sir.
Thank you. Next question is from the line of Viraj Kacharia from Securities Investment. Please go ahead.
Yeah, hi. Thanks for the response. I just had one or two more questions. One was on the JV. If you can share the numbers for 9 months, how much we would have done in terms of sales, EBITDA or profitability?
Yeah, we basically, give the details in the annual report. So at this juncture, we'll not be in a position to give you the details.
Okay, but would it be PAT positive in the 9 months? Just trying to understand.
Yeah, absolutely.
Okay, got it.
We are EBITDA positive also and PAT positive also in that company.
And there's a good clip of growth.
Yeah.
Yeah, because
that company, the base is small.
Yeah.
So this year we are having a good growth in that company also.
Okay, because last year I think there were some expenses which we had to incur. There were some operation challenges, so we were trying to work on that. So hence I was trying to get a flavor of how things have been on a 9 months basis in this year.
Yeah, see, absolutely. In fact, for one particular model last year, that part we had to incur significant costs on the development and on the trials, etc. So which had an impact, but nothing so far this time. Obviously, see, you must realize the fact that the cost pressures have been there. So those obviously will have a bearing, but nothing on an untoward basis.
Got it. And second question was on the capex. What kind of capex we're looking to spend, for 20, and how much we would have spent in 19 so far?
See, in 19 so far the spend is close to 40 crores, and the number for the next year we are basically working out as to what the total number is going to be. So we are working on a detailed exercise on that. So that number should basically be ready in a month's time or so.
So we have our board meeting to discuss this budgets and everything, which is scheduled to happen in the first half of March. So post that, once the board approves of the complete budget, then we will be able to give you a better idea of what is going to happen in 2020.
Okay. Just last question, if I may. So we seem to have a very healthy pipeline of new products we have worked on, and we expect them to commercialize next 1 to 2 years. In last couple of calls, you mentioned that you're also looking at new product avenues, new areas. So if you can dwell a bit further, if I look at next 3 to 4 years from a business point of view, the focus would largely be on these, or has there been any further development in terms of new product areas or new segments which we expect apart from OE as a growth driver?
No, we are primarily focusing on the OEMs only, and we are sticking to our core competence of extrusion process and of injection molding process. But as we've always maintained our stand that we are looking at opportunities to enhance our product portfolio, keeping these two competencies at hand. So, like last year, we introduced this instrument panel for SML Isuzu trucks. So now we are scouting for more opportunities. We've had a couple of discussions with Maruti as well, but unfortunately that project did not work out with them. But with Maruti also, we are scouting for new opportunities. Like today, if you look at the facelift of Baleno, which is launched, so that the front grille completely is being done by us from our Gujarat operations. So that is a new complete product for us, which we've introduced this year. So there are a couple of other things which are in pipeline and which should be getting rolled out this year.
Okay, fine. Thank you. That's all from my side. Thank you very much.
Thank you.
Thank you.
Mr. Kacharya, does that answer your question?
Yeah, that's all from my side.
Thank you very much. Next question is from the line of Vaibhav Bachatia from HNI Investment. Please go ahead.
Thanks for providing the follow-up opportunity. Just wanted to understand the broad nature of our contracts with the customers. So, I mean, is it product-wise pricing that we have with the customer, and what is the nature of that pricing? Is it fixed for a particular number of years, and how the escalation works on those price points that are fixed?
Yeah, the pricing is basically determined at the project level. So whenever a new project is conceived, the parts are discussed, and alongside that, upon the LOI level stage, the prices are also fixed. Now, and then there is this trajectory of changes that can happen over a period of time on that. So, like a foreign exchange change that you get or you give. Then there is this element of the efficiency sharing that happens, and so on and so forth. So the price gets determined at the project stage, and that remains till the culmination of the project.
Right. Okay. So basically, the base price that is fixed at the time of new product launch or the new project, that doesn't see any change during the lifetime of the product. That's what you're trying to say?
Absolutely. Basically, it's all BOM driven, you know. So if the prices change on that significantly, then we can have a discussion, we can have a representation, but otherwise the base will obviously remain that only.
And what you're saying is that there's no fixed tenure of these contracts, like 3 years or 5 years. It just runs till perpetuity.
Yeah. The project remains in OEM or in the OE category.
So is this the industry practice, or it's our contracts are a little different than our competitors or other OEMs?
No, it's as per the industry practice.
Okay, fair enough. That's it from my side. Thank you.
Thank you.
Thank you. Well, ladies and gentlemen, as there are no further questions, I would now like to hand the floor back to the management for their closing comments. Over to you.
Thank you, Janice, and thank you, Gaurav, for organizing this conference call. I would like to pay my sincere gratitude to all my analyst and investor friends who have taken time out of their busy schedule to listen to us today. In case you need any more clarification, we would be very happy to welcome you to our facilities in any region. We are very interested in showing you the kind of efforts that are being done to achieve the financial results which were discussed today. So please engage with us in case you have any further query, and thank you so much for today.
Thank you, sir. Well, ladies and gentlemen, thank you for being a part of this conference call. If you need any further information or clarification, please mail at gaurav.g@conceptpr.com. I repeat, gaurav.g@conceptpr.com.